All right, good morning and welcome to another edition of the Weekly Market Note here at Main Management. I'm Alex Varner, head of research alongside
James Maxwell, VP of Research.
Let's get into it. The big news, I guess we'll start with performance here because we have that slide every week, but largely positive on the week, although healthcare dipped back into negative territory on a year-to-date basis, still treading water, kind of struggling, leading up the rear. Comm services and tech continue to lead. And the S&P is now up 13% year to date. So solid performance on the week. 50-50 on the week on the sector. Sorry. And then the negative performers on the broader indexes were commodities and fixed income down a bit, led by the NASDAQ and small caps on the upside. The big news on the week that was is the FOMC, and they kind of, I guess, restarted their cutting cycle after pausing from last December. Basically, they cut 25 basis points, which was expected. I think the takeaway was the median dot, so that's 9. In this case, it was 9 of the voting members. Is 2 more cuts this year, so likely one in October, one in December, then one more cut in 26, and another cut in 27. I've seen kind of opinions from different investment houses ranging from they're done to we'll get like 4 cuts this year. So there's a wide range of opinions out there. You saw that in the dot plot, what we'll touch on in a sec. But basically, the summary of economic projections was more positive. GDP growth was revised up for 2025 and 2026 and 2027. The unemployment was largely unchanged to a little bit lower, actually, from June. Inflation was was unchanged in 25, up a bit in 26, and then core PCE again. Also, that's the preferred inflation measure. Was unchanged from June, but up a little bit in 2026. So, kind of on the not a huge shift in kind of forecasts here. One of the questions we've had is what happens when the cut, or what does it mean when the Fed cuts when markets are basically at or near all-time highs? And JP Morgan did a good piece on this, where they said the Fed has cut rates with equity markets within 1% of all-time highs 16 times in its history. The S&P 500 was higher a year later every single time with an average return of nearly 15%. So you actually get better than historical returns here.
Right.
And part of that is because lowering rates makes growth easier. It makes financing growth easier. So that helps companies kind of go out and potentially, grow earnings, borrow to fund their, to fund their spending, to grow sales. And also, it does spur economic growth. So looking at that, that's a positive. I think some of the concern is maybe they're throwing fuel on the fire. There's talk about a bubble. I think another thing that we've seen with the bubble is the peak valuations in 2000 were like 43 on PDE, and we're at 25, 28. So I think that's a good metric. And also kind of margins and earnings are better than they were as well. So that's a key thing to keep in mind despite the high valuations.
Yeah, a couple of thoughts on this. That one stat about cutting when the S&P is near its all-time high, I think the kind of look through on that is if the Fed is cutting kind of preemptively, or the words that Powell used were kind of like insurance cuts.
Risk management.
Risk management as a risk management tool. That's a much better dynamic than if the Fed is kind of on the back foot cutting because they have to.
Yeah.
If there's a shock to the economy and all of a sudden
their hand is kind of forced.
Yeah, like like a COVID or like a 2008 where you kind of need to start cutting because everything is falling down around you and the Fed just is doing these emergency cuts, then that's a much different environment than saying, hey, things are marginally kind of weakening. There are some risks out there to either side of the picture.
Yeah.
And we need to cut to kind of naturally kind of bring down rates to what the market expects if you look at like a 2-year.
And they knew when they hiked 550 basis points in 22 that they were clearly hiking above the long-term rate. And the long-term dot is at 3%. I think, so they're starting to get back to that. They recognize, okay, we have been restrictive. We're at 450, now 400, 425. This was more restrictive than necessary. And so to ease conditions a little bit, it's kind of funny because they say they're data dependent, and I don't doubt that. But data dependency kind of means that you have to see the data materially weaken in a way.
It's a inherently lagging.
And so you are kind of behind the eight ball.
Yep.
And here they're kind of saying, they kind of made it clear, hey, we're willing to be a little bit ahead of where we think things are going in an effort to kind of alleviate some of the, and it's been overly tight, I
Right.
think, from a policy standpoint.
Right.
They haven't, the free money doesn't, at 4.5%, 4% is not a thing.
Right.
And so I think getting towards that long-term rate is a positive. Clearly markets liked it.
You also saw between this meeting and the previous, the employment report that was quite bad with all the revisions accompanied with it. So that I think has also painted the picture where probably brought more of the members on board to say, yeah, we'll probably need to cut more than previously thought. And that's why you see that now expected 3 total cuts for this year. So two from this point, 2 more from this point.
And you can see here on the chart, 82% of the policy rate being 50 bips lower come December. Kind of one October, one in December. And the Fed, I mean, Powell acknowledged, he's like, we have very kind of blunt tools. Like,
right.
it's they're using one tool on the entire economy, basically, and it's interest rates. And they kind of have to look at their dual mandate, which is employment and inflation, and they pick, okay, which one is further away from where we'd like it to be. And clearly they're willing, in this case, to be okay with a little bit higher inflation for the time being. And they're hoping, again, we don't want to go back to the transitory semantics debate there. But they said, okay, the labor market at this time is further away than where we'd like it to be. That means we need easier policy.
Right.
So that's kind of that's the main reason that they've started to cut.
The blunt tool part is, I think, something I'll echo, where they have some other tools in their back pocket, but essentially all they have is really the ability to influence the short end of the interest rate curve. So the issue that arises is they have this one kind of policy that they're trying to manage, both inflation, obviously, and then the employment picture. One of the interesting things, if you actually go back to the previous slide on the SEP summary of economic projections, for those who aren't aware, basically this is polling the different members of the FOMC, asking them what they think these different economic variables will be over the next few years in the longer run. You can see that on the unemployment rate, it's basically hovering below where it is right now, or about where it is right now, 4.5 for 2025, and then just kind of drifting down to 4.2. Similar thing with inflation, right around 3 or 3.1, drifting down to 2. That kind of drift down suggests that the economy is going to be fine, right?
Yeah.
Like they revised GDP up, and unemployment rate is about where it should be, PCE where it should be.
Yeah.
It's like that's a very rosy picture that they're painting.
Yeah.
The reality is, I think, what they have to put on this SEP, what they have to kind of forecast, is not true to maybe what they actually think. Because if you think about it kind of from a, I don't know, game theory or as being a Fed member, you're not going to say, yeah, I think unemployment's going to be 10% in 3 years, right?
Yeah.
Like, even if you might worry about that, or worried about maybe 4%, 5%, 6%, if you're worried about that, it's very unlikely you're going to put that.
Yeah.
Same thing with inflation. You're not going to say it's going to be 3 or 4% in the longer run, because that inherently is saying you are not doing your job correctly.
Yeah.
That is just something to keep in mind. So it's important to listen to the language that they're using as well.
Yeah. Continuing on, there's also been some talk about the independence of the Fed, with Trump attempting to fire Governor Lisa Cook, his constant pressure on Powell, just haranguing them to cut rates, cut rates. He wants the long-term run to be 1%, or long-term rate to be 1%. The Fed clearly, we kind of viewed this summary of economic projections and the dot plot as indicative that the Fed is operating independently as we think it should be and is. But you can see, just, and the evidence for us there is, one member thinks they should cut rates 5 more times. Another member thinks they should not have cut.
Yep.
They wanted to keep rates unchanged. The median is 2 cuts. But again, there is some dispersion here. And the point being is that if you saw a Fed that wasn't operating independently, that was kind of under the heel of the administration, then you would have seen a much more consistent vote across kind of the party line that Trump wants.
Right.
And the fact that there was this dispersion shows that people are thinking independently and expressing their own opinion, which is the way it should be.
Yeah, I think it's different members are focused on different things. If you're really, really focused on inflation, you're going to be worried that it's going to be sticky and you're not going to cut as aggressively. If you're worried about the labor market, you're going to cut more aggressively. It's kind of a a simple dual
and different,
mandate.
and that's why they have all the 16, 17 voting members,
Yep.
is because they have different priorities in different places, and you want
Right.
kind of an aggregate as to where where the things are going. Okay, switching gears a little bit from the Fed to the kind of other hard data that came out. Retail sales were up 0.6% for both. Sorry, for both the control group, the overall, and then core was up a little bit stronger at 0.7 roughly. Those both accelerated on a year-over-year basis. That core reading is up 5.4 year-over-year. That's the best since December of 23. I think the good news here is that there was concern about consumer spending. You can see the last 3 months have been solid.
Yeah.
And this was a concern when tariffs were talked about, put on, implemented, that the consumer would totally pull their head back, kind of go back into their retreat into their shell, so to speak. And that has not been the case. They've been out there spending. I think again, you can see here on the different categories. Non-store was up the most month over month at 2. The laggards are department stores and miscellaneous on a month over month, and then year over year, again, miscellaneous are actually at the top, followed by non-store, and then the laggards on a year over year department stores and building materials. But again, this is kind of the narrative that you really just don't want to bet against the U.S. consumer. I saw a stat. People will nitpick and say, "Hey, okay, this is a bifurcated economy where I think I saw something where it's like the top 10% of consumers is responsible for 50% of spending." So that's a dynamic.
Yeah.
I think I'm not saying whether it's good or bad, but also I think that it's not. That's historically also been the case. That's not a new shift where all of a sudden the top 10% was responsible for 10% of the spending and now it's 50. It maybe was 40 or 45 and it's increased a little bit. But I think the bottom line is that that top decile of the consumer has been responsible for the bulk of spending for a long time.
The power rule kind of rules all, so to speak. It's kind
and
of
they're
everywhere.
largely agnostic to prices, or insensitive, inelastic on their demand, because they go into the grocery store and they have the purchasing power, and they're not going to be like, oh well, bacon's up $1, I'm going to buy something else. They just buy the bacon and kind of say, they complain about it, but they do it. So you're seeing that kind of continue here, where overall spending has been solid, which is a good thing. Industrial production also surprised to the upside, up 0.1 versus forecast for a negative reading. Similar in manufacturing output, also up 0.2. Again, above forecast for a decline. The year-over-year numbers tick down, but again, these have been kind of trending a little bit sideways to up, which is a good thing. The gains in August were driven largely by motor vehicles and parts, which have been contracting. You can see that on the left here. They were down prior to this reading. They were down 4 of the last 5 months, and have been choppily kind of moving higher on a year-over-year basis. And then you had a mixed reading on the capacity utilization, where a total utilization inched down to 77.4, while manufacturing saw it tick up to 76.8. Again, those still remain pretty far below their long-term medians. And this is kind of a question on productivity as well, as it's, if you have more productive machines that take up less space, and you have a 2,000 square foot factory, call it, and you used to use all 2,000 square feet, or maybe 200,000, sorry, and then all of a sudden you have more productive machines that allow you to use only half of that space. Is that a decline in capacity utilization? Technically, I guess, if you're depending on how you kind of measure it. But again, your productivity is increasing. So it's kind of an interesting, piece to look at.
Yeah, it's like an old school way of measuring manufacturing productivity that might not always be apples to apples.
Yeah, exactly. We also got import and export prices. Both were up a little bit more than forecasted. Import prices were up 0.3, export prices were up 0.3 as well, versus expected declines in a flat reading. So import prices are now flat year over year. Export are up 3.4, which is the biggest since December of 2022. It's important to note that these price indexes don't include taxation, so they don't account for tariffs. And basically what this means is that foreign companies are not lowering their prices in an effort to offset the tariffs. They're not looking at it and saying, oh, well, Trump has now levied a 30% tariff on good X, Y, or Z. We should lower our price to make it more palatable. They're just keeping things as they are.
Yeah, that's one of the things I've been looking at this series, in particular, the import prices, seeing if it's moving at all. If it's moving down, that would imply, as you're saying, that the foreign exporters are lowering their prices to kind of eat some of that
incentivize consumption.
Yeah, saying, okay, we'll cut it by 10%, and then the tariff will increase it by 10%. Overall, it'll be net, neutral. You haven't really seen that, which I think is something that there's been a Goldman report talking about who's eating the tariff costs. A lot of these different measures all suggest that the foreign exporters aren't eating a large proportion of these tariff costs, at least not yet.
Yeah. On the housing side, this continues to just languish. Housing starts and permits came in well below forecasts. Starts move lower to total starts move lower to one spot 307 million units. Single family were down, multifamily ticked down as well. Total building permits fell again to one spot 312. These are running right at the same kind of seasonally adjusted annual rate, funny enough. But that's the lowest since May of 2020. So I think again, high mortgage rates continue to weigh here. At least from this, again, these are trailing and a little bit dated. We get new and existing home prices this week, or sorry, new and existing home sales and prices this week. So we'll see if there's any kind of start of a turn here. But on the weekly, the kind of higher frequency data, the MBA mortgage data, as the mortgage rates have come down and this is really the 30-year rate, effective is at 655 and contract at 639. Those are the lowest levels since early of October 2024. As rates have come down in anticipation of the Fed cut, you can see the applications and refi indexes have really shot up, and they're at their highest levels since spring of 22. So that's 3.5 year highs on those applications and refis as people are starting to take advantage of these lower rates. And you can clearly see that if these continue to come down, and I think I've heard, a 5 handle would do wonders for at least a mental level of consumers, where it was at 7.5. Now it's, if it gets down to 5, that's a big difference in their mind. So they're now anchored higher they're no longer anchored at 2.925. They're anchored at 7. And so if you come from 7 to 5, people will view that as attractive, and hopefully we'll see some start to unlock in other areas in the new and existing home sales and the permits and the starts that kind of feed through into that. So again, you got to start somewhere. This is certainly more signs of life than we've seen in a long time for the MBA indices, which are a weekly thing. So that's kind of the high and the low of it. Again, the big news was the FOMC cut by 25 bips. We think they're still independent, but they have 2 more cuts this year. 1 in 26, 1 in 27 are kind of the median. Again, that's TBD if they're data dependent or if more risk management is warranted. We shall see. Retail sales and industrial production both came in above forecasts. Good for good for both of those, kind of chugging along. Import and export prices were also above expectations, which again, as we said, basically foreign companies aren't lowering prices to offset tariffs, but that clearly hasn't shown up yet in the spending. Still chugging along there. And then housing starts and permits missed pretty badly, but the MBA data shows some green shoots within that housing sector. This week, the big piece is we get the final reading for Q2 GDP on Thursday. We get durable goods orders, and then core PCE, which is kind of that final piece of the Fed inflation. Again, that's massively lagged. This is an August reading. We're getting a full, basically 30 days late, and that's not new. It's always delayed. But it's kind of funny where you get the prior month's core PCE, and then the next week usually you get the following month's non-farm payrolls. So two of the big data points for the Fed coming in the next 2 weeks here. That's kind of the long and the short of it. And we thank you for joining us once again.
Great. Thank you.
Take care.